Welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Now let's make some money and get a lot smarter. Here with me now, Quantify as a very special guest, senior fellow at the Independent Institute and longtime economist Judy Shelton. Judy is also the author of the new book, Good as Gold, How to Unleash the Power of Sound Money. Judy, good to finally meet you. I followed your work for many years. I actually follow you on Twitter, or is it X? I mean, I don't know. I have no idea, but good to see you.
X.
It is X, right? I want to talk about your books, but I blocked it off for the second half of this. This feels, maybe I could channel your economist background here. This feels like a big moment for Fed policy. Everybody's talking about a potential rate cut, what the Fed may or may not do. Does it feel like a big moment to you?
I love the way you put it like that. It shouldn't be a big moment. I mean, we shouldn't have everybody talking about what the Fed's going to do. I think it could be a revolutionary moment in the sense that people who never really experienced inflation before, who really never had their purchasing power pulled out from underneath them, may be paying more attention. And I think starting to question a system that depends on the discretion of a dozen people voting 8 times a year. I mean, the most important part of a capitalist economy is capital and the cost of capital. And it would seem to me that people might say, didn't we learn something from, say, the Soviet experiment, that trying to manage an economy, central planning, doesn't work. And so you would think that the cost of capital should be determined by free market forces of demand and supply of loanable capital. So I hope people start to say, we want to take back the money. And we think the value of the money should be inherent. It should work the same way for everyone, instead of having a central bank that can slant economic and financial rewards to one group of citizens at the expense of others.
I guess I wasn't going to go here, but should the Fed even exist? Or what does reform look like?
I think we have to go incrementally myself, but it's interesting. About a year after Alan Greenspan, after serving for nearly 18 years as the head of the most powerful central bank in the world, was asked, why do we need a central bank? On air, live. He said, he raised an eyebrow, well, you raise a very interesting question. And he ended up saying that you have to have some kind of a rule or something in place. He said a gold standard or a currency board, but something to restrict the issuance of money, or else ultimately you're going to have inflation with very deleterious effects, is how he put it. And he ended up that statement by saying there are some of us, myself included, meaning Alan Greenspan himself, who believe that the classical international gold standard worked very well. And he thought that worked without central banks.
What do you think the byproduct of the first Fed rate cut for this cycle be? Wow.
Political. I think the first byproduct will illuminate, for me, the problem with the Fed. It is too prominent, as I just said. We shouldn't be talking about the Fed's next move. We should be talking about the economy, and is it growing, and how are people doing, and are they retaining purchasing power, and do they have opportunity to gain more? That's what talking about the economy should be about, not what the Fed's next move is. It's too powerful. I mean, it has over a $7 trillion portfolio. It holds assets, most of them purchased to make it easier for Treasury to sell debt. And it's political. I mean, that will send a signal that will be very positive for markets. People will feel better. It'll start to reduce the cost of borrowing. People who hope to get a mortgage will say that's good. I find it interesting that if the Fed were to reduce, say, in September, which now it
appears to be the consensus on the street, at least.
It appears to be the consensus, and now I suppose the Fed can say the market made me do it. And they can start to justify it, but there's as many reasons to say no. You have massive fiscal stimulus. You have really still historically low unemployment. You had 2.8% growth last quarter. So tell me, why are you lowering it? You're over your 2% target. Tell me again, why are you lowering?
Should they even have a target?
I think the definition of stable prices, and we always hear the Fed invoking that as their mandate, stable prices, means zero inflation, not 2%. 2% is perpetual debasement of purchasing power. 2% is the government skimming. I mean, the dollar constitutionally is meant to be a standard, a store of value, invariable. It's in the same line of the Constitution as giving Congress to establish official weights and measures. It's meant to be a measure, even a universal measure. That was the hope, that people would say, as we define our dollar, that's what it's going to be from now on. Not taking 2% or 3%. A dollar in 100 years at 3% inflation is worth about 5 cents. At 2%, it's worth 13 cents. And you think if you can go from 9.5% inflation down to 2, why not 0? Why should people have to keep pressing their employer to give them a cost of living increase? Why every year you have to say, I'm not keeping up, I'm not keeping up? Frankly, the only way it really works for the Fed is if wages don't keep up with inflation. That's why there's a 2% target.
Yeah.
It's to fool people, to be able, through money illusion, to say, well, nominally, your wages went up 1%, but because inflation was 2, you really lost 1%.
Yeah. Is the Fed, you think the Fed will be the deciding factor in the election? When you say the Fed is political and they cut rates in September, maybe stocks go up more, to your point, mortgage rates come down, I mean, that could be a major deciding factor.
Well, who's unhappy about it? Who is unhappy? Mm-hmm. And I think if you complain, then people will say, but don't you want people to have lower borrowing costs? Don't you want to see the market go up? I'd say for the donor class, mm-hmm. It's great if you already own financial assets. I mean, it's really almost a progressive, classical liberal position to say, no, I think money should work the same for everyone. What if you haven't made enough in your life to have financial assets? How do you ever get them? And so the Fed, by its own model, would say, no, we need to get inflation down to 2. As I say, I think it should be 0. But if the Fed believes that you have to have restrictive interest rates, I call it punitive interest rates, and yet they say nothing about fiscal policy, they won't question it. So meantime, we're running this huge fiscal stimulus, massive deficit spending, that is spurring economic activity. I mean, the government's proud of it. Look at all that we're doing. We're building everything. And that's spurring economic activity, while the Fed is saying we're trying to reduce economic activity. That's why we have restrictive interest rates. Well, that's not stopping the government from spending. It's only hitting private households and businesses. It's only hitting American families who say, well, I can't afford it. And the borrowing cost doesn't even go into the CPI, the Consumer Price Index. And yet that's an important cost.
What grade would you give the U.S. economy here?
I like the economy. I would normally always give the U.S. economy an A. The problem is when you have fiscal policy doing just what I said, allowing the government to spend, because they don't care what the interest rate is. Government will pay whatever it takes. But meanwhile, that high rate that the Fed is using to push back against inflation is hurting the expansion of the private sector. There are a lot of companies that were willing to hire people. Well, now they're not going to. They can't afford it. There were a lot of expansion plans for small business. They can't do it at these rates. So I think that what happens when you have dueling fiscal and monetary policy is you're expanding the government sector at the expense of the private sector. And I think that's very unhealthy for an economy if you're looking for equality and opportunity.
A lot of CEOs and executives I'm talking to, Judy, are starting to, at least to me, voice their concern about the Trump tax cuts rolling off next year. If they're not extended, how debilitating will that be to growth?
I think very debilitating. I believe in low taxes, less regulation. I think smart energy policy is important, savvy trade policy. But none of it really works if you don't have stable money. That's really, that's the platform you need to measure real growth, the kind of growth that actually helps people. I think what we see when people play with the money itself, and that includes being a financial speculator or more sophisticated derivatives. I mean, 600 trillion nominal value in derivatives out there.
Totally normal. Not.
You know, multiples over global GDP. And the problem is there's this increasing financialization of the economy. But the kind of growth that really raises standards of living for everyone is long-term, real productive growth. And I think you need real money and a stable monetary platform, not just so you can count on the money in the United States. And I want the dollar to continue to be the reserve currency, but you need to have a level international monetary playing field for international trade and investment to get optimal results.
How important, maybe I'll ask it this way. Why is the gold standard so important to you?
Well, there's no going back to something that we had. That's what I think is interesting about money. It moves forward. But I've sort of talked about a back to the future approach. One thing about gold, as I say, this very liberal aspect of it, is it would, in the classical international gold standard, it worked the same for everyone. If you thought, it's more of an organic approach to controlling the money supply. If you thought that things were getting frothy out there, if you thought that there was too much credit, there was too much speculation, you at the margin could turn in your money, your paper money, and say, I'd rather have the gold. I'm just not sure this is all justified, this irrational exuberance. Now, instead, it's controlled it's the tools the Fed uses. It has administered rates. I don't think people really understand the way the Fed works today because it has changed in the last few years. The Fed pays banks not to make loans to their clients. The Fed pays 5.4% on cash. These are cash deposits held by financial depository institutions, about a third of them foreign-owned, at the Federal Reserve in their system district banks. And that amount is about $3.4 trillion. So the Fed is paying over $200 billion a year to private commercial banks to induce them not to make loans. So a lot of people think, well, the Fed, they know that the Fed bought Treasury debt. They know the Fed has a huge balance sheet, asset portfolio of Treasury securities and mortgage-backed obligations. But what they don't think about is the liability of the Fed are those reserve balances. And the Fed could buy another $10 trillion in government debt. That doesn't mean it has to be inflation. If the Fed then corrals that by paying banks not to lend it out, if a bank could get, say, 8 or 9%, they don't have to do a thing. They don't have to hire loan officers. They don't have to set aside a loan loss reserve. They don't have to monitor it. They don't have to check out the borrower. It's easy, easy money, and it's sitting there dormant. It's not buying anything. It's not investing in anything. That, I think, is really the perverse incentives. It's like paying people not to work. It's like paying farmers to destroy their crops. And that, I think, is, if people understood that that's how the Fed raises and lowers interest rates these days, it's called the interest on reserve balances. That's the 5.4%. That's the Fed funds rate. They used to do it by trading Treasury securities. They virtually stopped that now, because otherwise they should be whittling down their portfolio holdings. Why should they be holding Treasury securities equal to a huge fraction of the economy and a massive portion of the total U.S. government debt outstanding?
Oh, I love that you broke that down, Judy. Hang with us for a second. We're going to go for a quick break. We'll be right back on the latest edition of Opening Bid. All right, we're having a fascinating conversation here with Judy Shelton of the Independent Institute, also the author of the new book, Good as Gold, How to Unleash the Power of Sound Money. Judy, I want to talk about your book a little bit here because I am really enjoying reading it. And I loved that you started right off the bat talking about the nominating process. For those not familiar, of course, former President Trump nominated you to join, the Fed Board of Governors?
Yes.
Tell us a little about that process. I don't want to give the whole book away, but it was tough. It was tough.
You know, I'll say in advance, I'm very glad I went through that process. But it is interesting to have been a scholar at the Hoover Institution at Stanford. I've been there 10 years. I had the same rank as Milton Friedman, a senior research fellow. And
That's amazing.
I could meet with him.
That's really amazing.
Down the
Congrats.
hall.
That's cool.
I had access to some great minds. And I wrote a book called Money Meltdown in 1994, so 30 years ago. But it just laid out different approaches to regulating money, with the idea that ideally you want to calibrate the amount of money and credit to the needs of the economy. You don't want too much, too little. How can you do that? Well, if you look historically at systems that have worked and or failed, I think there's a lot to learn. So I looked at the classical international gold standard. There were some good things about it. For one thing, money meant the same across borders. So you look back that many years ago when it was in operation, and it actually gave that level international monetary playing field. It empowered every holder of money, every holder, with the same convertibility privilege. If they were uncomfortable with what they thought was the level of money and credit out there, they could turn it in, they could convert it for gold. And then another system that we had after the classical international gold standard, it was created in 1944, called the Bretton Woods system. Other countries didn't have to have their currencies convertible into gold. Only the US dollar was convertible into gold at the rate of $35 per ounce of gold, which was the correct price at the time. But the only ones who could exercise that privilege were foreign central banks. And the idea is, if you did that, then you had fixed exchange rates. And even this program, which now people think is some kind of retrograde, was so forward-looking because it was conceived by the U.S. Treasury Department to give hope to the Allied forces. These were people still in the throes of World War II, fighting the Nazis. And what the U.S. wanted to do is to say, if you get through this, if we win, you're going to have a better economic future, more opportunity. We're going to help you rebuild. And it's not going to be like the 30s, because the 1930s were the Great Depression, which really led into World War II. And it was characterized by countries depreciating their currencies, making them worth less so that they would have a trade advantage. Because if you devalue your currency, then you can sell your goods to another country and it makes the price come out cheaper because they're at their old fixed exchange rate and you've now devalued yours. So that's what we'd call currency manipulation. And so the US wanted to say, we're not doing that. So we're going to set it up so we have fixed exchange rates, and the anchor for that will be this dollar convertible into gold. And that era, when we were under that system, the Bretton Woods system, for 25 years, we had shared prosperity around the world. We had a lessening of the inequality of wealth, especially in the United States. And it was productive growth, where you just raise the standard of living. And I think that having real money and a platform based on stable purchasing power, where you could count on money as a store of value, as a unit of account that had meaning across borders, and then a medium of exchange because it was convertible at fixed rates, was extremely valuable. I don't know why people wouldn't say, hey, that's a good approach.
Well, that's what I was trying to figure out, because I remember covering that process, reading the book, and I came away thinking, why your ideas seem so extreme? It's like you were put in a box and don't touch our ideas or don't entertain them. But they seem pretty logical.
Well, I just feel that Government owes people a money unit of account that means something. I mean, when government skims, and inflation is skimming, takes away the value, it's expropriation without due process. You earn the money. All right, let's say you put it under your pillow. Someone may say you're not a sophisticated investor, but you say that's not my world, I don't want the risk. Well, let's say you take it out 10 years later, and at 2% inflation, 20%, it's like there was a 20% tax, and they took it away for no reason, and in kind of a sneaky way. Or let's say you bought a house and for $400,000, and you live in it for 10 years, and even at 2% inflation, now you're going to sell it, and it's $480,000. You didn't really gain anything, but you're going to pay tax on the capital gain, even though nothing changed in the value. And as I say, having to always bargain with your employer, oh, now I need a cost of living adjustment, constantly. For the Fed's convenience, that's why we have 2%. For the one reason, this money illusion, that if we have 2%, then people won't be disturbed. If they're actually losing money, the inflation will cover it up. They'll see nominally the amount was higher, even if it doesn't keep them even with inflation. And secondarily, the Fed would say, well, we need room to maneuver. We need to be able to go from 2% to 0. Well, Fed stimulus in the event of a recession always moves 5% to make a difference. So that argument doesn't really work. But why for the Fed's convenience? And this is why some people say, well, maybe it should be 4% inflation. Then we'd have a lot of policy space to reduce it. But has it really helped? When the Fed stimulates, I think it ends up causing more problems than it resolves. So that's not a good reason. So to me, there's a moral factor in money. And when I found myself being attacked for that, and often by pundits who really didn't understand that for the giants in the arena, people like Paul Volcker, who I talked with regularly.
Literal giant. I mean, the guy's
Yeah,
really
he was
tall.
very tall.
Literally tall.
Tall Paul was a wonderful human being, and it was a pleasure to know him. And we talked for hours about these things. I once did a 3-hour interview with him, recorded, and also with Alan Greenspan regularly. They talk about gold as a bulwark of monetary credibility. That's why all the central banks hold gold. They recognize it. So I didn't understand why cheap shots were made to suggest it was unsophisticated. It's the most sophisticated people I know, including Nobel Prize winners, talk about money and gold as a way of explaining how to get to a stable monetary platform.
In the couple minutes we have left, Judy, let me ask you this. If a lot of people that I talk to have you on the short list of being considered potential Fed chair if former President Trump wins 4 more years in the White House, would you want to go through this process again? And would you want to be Fed chair?
Well, of course, it would be an honor, and I was very much honored that I was put forward and defended by the Trump administration, and President Trump stood by me because I had 2 senators out with COVID who would have voted for me. And then there were, frankly, 2 senators on the other side who also were supposedly self-isolating for COVID, who somehow managed to make it back to D.C. 2 days later and vote against me. The process, it was hurtful, but I was renominated after the end of the year by President Trump and only removed by President Biden. Would I take it again? Well, as I say, I would. My idea of reforming at the Fed would go first to wanting to take this overhead view that the Fed should be less prominent, less powerful, and certainly less political. The people who say, who are so concerned about the independence of the Fed seem to be the most vehemently against any kind of rules-based approach. Yeah. They want to give total discretion. Well, that doesn't work. If you have people with total discretion, these are political animals. I mean, one reason the Fed thinks it's independent, it likes to say, is that people in the administration or elected officials can't be on the board of the Federal Reserve. But you have a Fed chairman, Janet Yellen, who became Treasury Secretary, the most important official in the cabinet of the president. Couldn't be more political. You had the vice chair, Lael Brainerd, go straight from the Fed to being the head of the National Economic Council, the #1 advisor speaking into the ear of the president. So I don't think these people became Democrats the day they left the Fed. So I think that if you really want to make the Fed less political, it's a matter of having rules in place that assure people what will happen and not just have them hanging on the next Fed meeting, which is great if you're wealthy and you can listen to all the cable news channels on financial.
Or tune into Yahoo Finance, of course, where we have all this news coming.
Which I highly recommend.
Thank you so much.
Which is absolutely required. But a lot of people really have to be out working on the street. And I think it's a luxury. I think the money has to work for them, and they have to be able to count on it without knowing the Fed's next move.
Well, we have to leave it there, Judy. I'm going to say that I think your hat's still in the ring. We'll leave it there. Judy Shelton, good to see you. This is a real treat. This is a real pleasure to start my morning. Of course, Judy Shelton of the Independent Institute, longtime economist, and the author of the new book, Good as Gold, How to Unleash the Power of Sound Money. I encourage everybody to give this book a read. It's good to get perspective on the other side of all things Fed. That's it for the latest episode of Opening Bid.
Thank you.